Hi, welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. Jeff published his note on Sunday, which is available to subscribers on Substack at hugeinsights.substack.com. And of course, don't forget to like and subscribe to Your Finance TV to stay on top of our content as well. Jeff, welcome back.
Great to be here as usual, Mehdi.
So as we're filming this early on a Tuesday morning, not that early, pre-market on a Tuesday morning, futures are a little bit weaker, down about 20 basis points. And I feel that the narrative is very similar to last week, a touch bearish. Everyone's kicking around the debt ceiling non-resolution at this point, a couple of weaker earnings reports. And, so what better way to address these concerns and thoughts than to sit down with Jeff and go through his thoughts from Alpha Insights. So Jeff, we should dive right in with your thoughts. There's so much to talk about.
Absolutely. Obviously this morning we got a pretty big miss by Home Depot. I think it was the biggest miss in 20 years for them. They missed their top line expectation by $1 billion, which is completely unreasonable for a company like that who should really have control of their numbers. I'm surprised they did not come out and pre-announce weeks ago. $1 billion is a big miss. And I'm also surprised that the market is just kind of brushing it off. It's a Dow stock. The Dow's not even down 100 points. This to me is indicative, especially with their forward-looking guidance of weak demand. It's really indicative of what we've been talking about for some time, which is a stark deceleration in economic growth that appears poised to, result in an economic recession in the U.S. sometime in the back half of the year. We believe it's starting right now as we speak in the middle of the second quarter, as per the LEI indication model that we've been talking about for months. Last week the market was down 0.25%. Big deal, right? We're kind of the same right now. I'm taking a look at the last 6 weeks price action. We've been in a choppy range. Last week we traded in a 56-point range on the S&P 500. We've really been in a 150-point range for the last 6 weeks. And it tells me that the market is getting ready to break one way or the other. The setup that we've described in our work is really the most bearish I've seen in the better part of the last 15 years. And with that, my expectation is for lower prices. That being said, we did get kind of a monkey wrench thrown into the equation a week ago Friday, so 2 Fridays ago, where we saw a sharp upside gap that left an island reversal pattern potentially intact. What would negate that pattern would be filling the gap, and we have not filled the gap at this point. The longer we go without filling the gap, the more likely it is that the market pushes above the February high. So far, it has held below the February high. In fact, if we take a look at the NASDAQ 100, which we don't really write about separately that much, but we did put a special note out last night to subscribers only, and I'm not going to go into great detail on it, but I will say this. The NASDAQ 100 is less than 200 points away from its 50% retracement, which is a, kind of a key resistance level. It's a key reference point, and it's not uncommon for counter trend moves to top at or about a 50% retracement. So we're pretty much right there. We're also holding below the 100-week simple moving average on the NASDAQ 100. And that moving average is declining still. So, we've got a moving average that's in decline, that's holding price below right about at the 50% retracement. And frankly, the NASDAQ's been holding up the whole market, okay? There's about 25 stocks in the NASDAQ 100 that are driving the market's performance. And honestly, I don't know how much longer they can hold up. I think eventually we're going to see a break. The question is whether we see one last surge higher before that break begins. And, we'll know in the fullness of time. So, with that, Mehdi, we continue to advise our clients to remain patient. to minimize net equity exposure and maximize cash reserves. We are elated to own the 3-month T-bill, which currently yields 5.25%. That is our preferred proxy for cash right now.
Still on the cash, I hear you. Be conservative. Volatility also has been quite low. We've discussed this over the last several weeks and months, and the S&P has been holding in, as you said, kind of in that band, that range bound kind of period. And so, is this like a ticking time bomb?
Well, we titled the chart "Tick Tock, Tick Tock." It's a matter of time in our view that we see the next volatility spike. As the study shows over the last year, every time the VIX has pulled back into this kind of 20% or sub 20% range, it has marked a tradable high in the index. And every time that's occurred, we've seen a reversal and a spike in volatility, which is ultimately, crescendoed around 34% up until very recently. And those crescendos had marked, tradable lows in the market. And so, the question that, we have to ask ourselves, okay, we just saw, I believe on May 1st, the lowest level on the VIX since November of 2021. We came in around 15.5%. And the question is, will we explode off that 15% level, or will that result in lower lows? And if we look at the study, the indication is that, as the VIX recovers above its 21-day moving average and ultimately above the 20% mark, it results in a volatility surge or a VIX spike up into the, kind of low 30% range. I think we should be looking forward to that going, looking in the weeks ahead. And honestly, I don't think it's going to stop in the low 30s this time. In our opinion, the next move for the VIX to the upside is in the 40% range. I think we will eclipse 40% for the first time in at least 2 years, and probably make it into the mid to high 40s before we see the VIX top. And in our opinion, that will be consistent with significantly lower prices in the S&P 500.
So, Jeff, as the title suggests, and I want my parents to listen to this very carefully because I'm not saying what they think I'm saying. Are we totally skewed?
We are totally skewed. And, as the VIX kind of measures, or captures the first layer of risk, implied volatility, how the market is pricing volatility of S&P returns, what the skew index does is it captures that next level of volatility. It illustrates how the market is pricing tail risk and specifically left tail risk. So, as the index increases, the slope of the implied volatility curve steepens. Okay, and so whereas like 100 is normal, those are normal S&P returns, and your probability of a 2 standard deviation downside move is around 2.3%. As the index moves up from 100 to about 145, you see a rather sharp increase in those probabilities to around 14.45% of getting a 2 standard deviation downside move in the S&P 500. And if I told you that you had a 14.45% chance of being in an airline crash, you would never board the plane, right? Those are high odds for a significant downside event in S&P returns. And 2 standard deviations is a big deal, especially when implied volatility is elevated. But what we see is, you can get the skew to move to an elevated point if the VIX is high or if the VIX is low. But generally speaking, when the VIX is compressed and low, like it is right now, on a relative basis to where it has been, so based on its recent history, and the skew is elevated above normal to the extent to which it is, that is a cocktail that tends to be consistent with a black swan event. And so, we don't know for certain that there's a black swan event or what in fact that might be. But when skew's elevated and VIX is compressed, that really suggests that the risk of a black swan is exceptionally elevated. And so at this point, we wanted to show both of these studies just to give our viewers and subscribers just a sense of how perilous the situation is. We don't know what it's going to be, but obviously the headlines are really discussing the risk of a U.S. debt default. I think that's extremely low probability event. Okay, but it would qualify as a black swan if it happened. The problem is black swans by definition are unpredictable, and everybody's looking at that. So I think it's not likely that that's going to be the problem. But there are many other potential problems that are looming that we're aware of and many that we're not aware of. So, I think it's just time to not to throw caution to the wind, not to be bold right now, but to be conservative. And, even those who are defensive and positioned defensively, may not be positioned properly in the event of a black swan. And so, we just don't know what it's going to be. And so you may think you're defensively positioned, but in fact, whatever you've chosen to do to position defensively isn't going to defend against the unknowable. And so, we think cash is the ultimate defense right now. People had been kind of hiding in big cap, mega cap, fortress balance sheet companies. That's the first rotation out of risk assets, right? Look at the NASDAQ 100 versus the Russell 2000. It shows that there's been a flight to quality, flight to safety within equities. The next move is out of equities and into cash. And so we want to be ahead of that move, one step ahead of the crowd, maybe 6 steps, who knows? But, we're kind of trying to find where the center of the chessboard is, and we think cash is where you want to be.
Cash again. Let's have a look at some technicals. We discussed it. We're floating around this 100, 150, 200 point kind of band sideways. What are your thoughts around here on some of these levels?
Well, I think it's important first to kind of look at the big picture. And if we zoom way out and kind of see where we came from, we had this epic rise into the January 2022 high at 48.18 on the S&P. That was a 13-year advance off the 2009 low. And, we believe that advance terminated in January of 2022, and that was an end of cycle wave 5, of super cycle wave 3, which was a very long-term 90-year structural advance. And if we're right about that, we think the current decline off of that January 22 high of 48.18 is actually the very early stages of a super cycle degree corrective waveform. Many people are talking about, the bear market bottomed in October. We don't even think it's begun yet, okay? We think we're in the very early stages of a super bear market that we have not seen the likes of really in 90 years, since the Great Depression, since the crash of 29 and the subsequent decline into the 1932 lows. We think something on that order of magnitude is what is evolving here. We're just not there yet. And people are so, they're so used to instant gratification. Nobody's patient enough to allow this to play out. And, we hear so many people trying to call the bottom, and, so many skeptics that are like, oh, you're a perma bear. They're just not waiting for this thing to play out. And if we count the waves, and we've got two possible scenarios that we've been looking at. One we call our preferred count. The second we call our alternate count. And the first count looks at the decline off the January 2022 high into the June 2022 low as being primary wave 1 down. And the subsequent advance into the August 16th high was primary wave 2 up. Everything that's followed that August 16th high, in our view, is part of primary wave 3 down. It's just been subdividing. And the first division was intermediate wave 1 down into the October low. And the second subdivision was intermediate wave 2 up, which topped on February 2nd. Based on this model, since February 2nd, we've seen minor wave one down into the March 13th low. The rally back so far into the May 1st, I'm sorry, yeah, I guess it's around the May 1st high. That is the top of minor wave two. And so now we're looking at minute wave one down and minute wave two up. We've got 4 degrees of trend, primary, intermediate, minor, and minute wave at work here. And the next break, once we break the level of 4,039, it will confirm all of this and really mark the top of a third wave decline at these 3 various degrees of trend and including minute wave, 4 degrees of trend, which could ultimately carry the S&P down to the mid 2000s before we see the end of wave 3. And that's not even the end of wave A. That's, we're just halfway through it. We're through the worst part by then, but we've got wave 4 and wave 5 to get through before we end cycle or super cycle wave A down. And so, our view at this point is that there's just a lot of work to do here. There's a lot of wood to chop. If we're wrong, the S&P will push above 4195. And if that happens, that'll shift us to our alternate count, Mehdi. And the alternate count just simply pushes everything out a little bit. It suggests that instead of the June low being the end of primary wave one, it was the October low. And that instead of the February or the August high marking the end of primary wave two is about to terminate. And we give it maybe another 100 points to the upside. Maybe we can make it up to around 4,300, 4,312. That's the exact 61.8% retracement of the entire decline into the October low. Whether or not it gets there exactly is less important as to where we are in the count. Once wave two terminates, primary wave two terminates, primary wave three down will carry prices dramatically lower. We think a good target for wave A is about 2250 on the S&P 500. Once supercycle wave A or cycle wave A of supercycle wave 4 completes, we think we'll be in that neighborhood, 2250 on the S&P 500. That's right around the 61.8% retracement of the entire advance off the 2009 lows. And, it kind of comes into play with some other levels, a previous fourth wave, extreme, 200-month moving average. All those things are kind of converging right at that level. We think that's a good support level. In the short run, is there a high probability that this, island reversal pattern carries us above that February 2nd high? It's about 55% probability. So, it's not terribly high, but it's slightly higher than it is the other way, right? And so we got to give that some consideration. We can't ignore it. The longer we remain above that gap, the more likely it is that our alt count will play out and we'll get a rally up to, say, 4,300 on the S&P. But anything can happen here. I'm looking at today's earnings report by Home Depot. We've got Target and Walmart later in the week. We've got a couple tech names, Cisco and AMAT. We are not looking for great earnings reports out of any of these companies. And collectively, we could see enough pressure put on the market to close that gap. And once that gap's filled, that takes that island reversal risk off the table in our view, and really puts us kind of squarely into that third wave decline at 4 degrees of trend. And, the key levels, again, 4,039 to the downside would confirm it. If we break below that December 22nd low, we think that's, really kind of the icing on the cake. And that would definitely get us pretty confident in this count.
Again, you maintain the consistency on that 2250 kind of level, which comes in every conversation we have. But listen, Jeff, you're consistent on this. You're giving us the layout on the upside of the island reversal, but both preferred and alt counts kind of point in the same direction ultimately. So
they do, and the only real issue here is the timing, and I think the lack of patience of market participants is really what's going to be their downfall. You're going to have to let the market play this thing out. There is no time element in Elliot Wave analysis. We can use other cycle analysis to try and converge time and price analysis together, but Elliot Wave analysis is purely based on price, and we just need to be patient, let the waves play out. And they seem to want to be going sideways at this point. And I'm not calling a specific level at a specific time. I'm just simply saying that the construct of the pattern points down. One other thing I didn't mention, Mehdi, is that there's a 50-day cycle that's been active since August, and if it continues to be active, it points hard down into late May. And so if we're trying to put some sort of a timing on this, we should see some evidence by, say, May 24th that we're in the neighborhood of seeing this thing play out one way or the other.
May 24th, there's a pretty specific date for something to watch. So
it's the 50-day cycle. That's when it ends.
There we go. All right, so we'll be keeping a close eye out on that. How about market internals?
They've been persistently weak. Let's look at it this way. We're measuring breadth, momentum, and net advancing volume. These are kind of the internal metrics that kind of tell us the strength of the market. And what we saw last week was breadth was flat. Advancers and decliners were basically even. And so that's not a positive. The other thing that we look at when we see breadth is that the 5-week moving average of net advancing issues has made a lower high thus far vis-a-vis the February high. That's a negative divergence. That is not bullish either. The middle frame evaluates momentum of the market, and we're looking at the S&P 500 unweighted. So we want to look at the momentum of all the issues, not just the cap weighted heavyweights. And what we're seeing is that momentum is well below the median line. It's a 5-week RSI oscillator measure. And not only did we make a lower high in momentum vis-a-vis the February highs, leaving a sharp negative divergence in that momentum study, but we're below the median line, which suggests that we're in a bearish momentum regime at this point. And then finally, net advancing volume. Net advancing volume was weak last week. I think it was 39% of S&P 500 volume was advancing. But if we take a look at the 5-week moving average, it's been flat for the past 3 weeks. And so, we're not seeing any progress there. And again, another negative divergence in that 5-week moving average. So, these negative divergences tend to precede a major trend reversal. And so if the trend has been up since October, we think the reversal means that it's going to be turning to the downside for a persistent period of time.
And Jeff, are we seeing any positivity emerge in sentiment?
Sentiment is a coincident measure right now. It doesn't have a lot of value unless we get to extremes. And what it's really telling me is that people are getting more positive right now. They've been more positive. They're getting more positive. There's 2 measures that we look at every week, and there's really not much to report with respect to professional investors right now. The name exposure index, which is the National Association of Active Investment Managers, came in around 65%. It was 67% last week, essentially flat. That's a neutral to fully invested reading. 75% is dead neutral. Over 100% is leverage. Below 50% is underexposed. So, they're pretty invested at this point. The other measure is the AAII. That's the American Association of Individual Investors. That is a notoriously bearish cohort to begin with. But we've actually seen a big spike in bulls. The bull level got up to, I think it got to 29.4%. Bears actually fell to 41.2% from 44. The spread between the bulls and the bears, or the bulls minus the bears, That jumped from about minus 20 to minus 11.8%. So it increased by 9 points. That was the biggest move I can remember in recent weeks. And so, we really look at that bull bear spread to give us a sense of the directional change of individual investor sentiment. And it has definitely shot up over the last week. What does it really mean? It basically means that people aren't selling. If they're more bullish, then they're probably buying or holding their existing portfolios. They're not selling. And so this would not be, from a contrarian's perspective, something to suggest we need to get more aggressive here.
Let's have a look at some of the sectors. Obviously, energy seems to have been quite the laggard last week. What are your thoughts going forwards for the week?
It was a mixed bag last week, Mehdi. I mean, we saw comm services was the strongest. Tech wasn't that great. We only had, I think 2 or 3 sectors that were even positive last week. Energy, of course, was the worst performer. It's been the worst performer this year after 2 stellar years. So in some respects, I guess we can't blame people for taking some profits there. Having said that, I mean, I continue to believe it's an under-owned sector. And it's undervalued relative to its true intrinsic value. And so, when I think about energy within a portfolio, I think it's an area that you want to have some overweight exposure to. It actually ranks in our relative strength momentum work. It still ranks as the top sector to own based on its long-term and intermediate-term relative strength and the momentum of that relative strength. Although it has been fading, continues to rank above all others. And so if I had to say where I want to place my bets, I want to be defensive. I like healthcare. I like staples, household products, that sort of thing. I like utilities, but I also like energy as a bit of a hedge on the economy and really just from a valuation perspective. The flip side of that would be, I think, tech, communications, discretionary, financials, materials, industrials. Those areas of the economy look like they are poised for a reversal, and it's already being led by financials at this point. That's the tip of the spear. And so real estate, I'd throw that in there as well. Those are areas I'd want to be strictly underweight at this point, if not short in some respects.
Well, that leads us nicely on to how we make some money in this market. Let's, we have our top actionable trade ideas as every week you put out 5 longs, 5 shorts on a pretty consistent basis. So what do we like this week?
On the long side, we like a consumer staples company called Celsius Holdings. The symbol is CELH. Stock went out around 131 last night. It broke out above 122 to resolve a year-long classic pattern base formation of the cup and handle variety. That breakout gives us a measured move count to 204, which is a significant upside potential. Given the significant upside potential, we would set our stop loss at a rather generous level. 104 would be our stop loss level. That would give us better than 3-to-1 positive risk skew to the upside and give a volatile stock lots of breathing room. But we think this pattern resolved looks good. Looks like we're going to get some follow through here. So Celsius Holdings on the long side. On the short side, there's a company called Danaher. It's an industrial company. Stock went out 227. Symbol is DHR. The breakdown below 239 gives us a measured move count to 148. This was kind of the inverse pattern of what we see in Celsius Holdings. It's a year-long inverse cup and handle pattern, broken trend line, broken support levels. And, with that target of 148, a significant upside potential for short sellers. If you're long the stock, we would sell it. We would avoid it. If you're short the stock, we would set a stop loss at 244 to protect capital.
Jeff, as always, really appreciate you sharing your thoughts from Alpha Insights. It's always
a pleasure.
And it's always a pleasure talking with you. So I appreciate that. I want to thank our viewers, and I want to urge you to check out Jeff's content on Substack at hugeinsights.substack.com. And also, don't forget to like and subscribe to our channel at Your Finance TV. Until next time, thank you for watching and good luck investing.